Hey Dave, how you doing today?
I'm doing great, Nick. How are you?
Doing well, doing real well. We are actually in the height of what we call our client review session right now. So we've
Yep.
been having tons of client meetings, and kind of the preface for today's episode is kind of spreading out to the masses the things we've been hearing and talking about in our everyday client review meetings, right?
Yeah. Lots of similar themes coming up, which is never a surprise because people are basically reading the
Yeah,
same news and listening to the same
right.
stuff out there, one side or the other, and the consistent things. So this has been a Fed week of all Fed weeks
Yeah,
because we're sitting here after one of the longest periods of no interest rate changes after
right.
a previous period of unprecedented increases. The Federal Reserve has just finally reduced interest rates and did it in bold fashion by reducing interest rates by 0.5%
Yeah.
earlier this week. So a lot of questions, not just from our clients, but like the press requests that we get, like what are you doing with client cash now? And a lot of the articles today, I saw three different articles on different news sources that were some form of, if interest rates are coming down, what are you going to do with your money?
Yeah, it's interesting and somewhat scary. And part of the reason why we do this podcast, right? Because a lot of those are like attention grabbing, like
Right.
emotional, like, hey,
Clickbait.
rates
Yeah.
went down. I got to do something with my cash. Like, this is
Yeah.
the end of the
Yeah.
world. Like,
Everything. Yeah.
if
Yeah.
you don't do something now, bad things are going to happen. Heightened
Right.
emotions. Like, hey, I got to
Right.
figure this out, right?
Right. When 0.5% compared to where we were in, say, 2010 through 2021
Yeah,
is like
right.
nothing, right?
Right,
So
exactly.
so but at the same time it is important for the markets and what's going on
Hmm.
in the world and the economy. So I don't want to we shouldn't we're not here pretending that a 0.5% rate cut by the Fed is not an important thing, but it
Right.
doesn't necessarily change our strategies with our clients. That's the big
Well,
thing.
yeah, that's just it. I mean, cash is, used for a specific purpose, so you shouldn't be changing your cash strategy all of a sudden because
Right.
interest rates go down a little bit,
Right.
right? Like that
Right.
shouldn't change your long-term
Right.
strategy.
So from an economy standpoint, and the stock market responded very positively over the last couple of
Hmm.
days
Right.
to this rate cut. But basically, the Fed has made it clear that they do not want to be the cause of a recession. They are willing
Right.
to lower rates. So the risk there is it may reignite inflation, right?
Hmm.
But
Hmm.
they're looking at the jobs market and basically saying, "Hey, we don't want to cause things to get worse in the job market because that's harder to undo than having to raise rates again later on to
Right.
stave off more inflation." So it's interesting how they're parsing that. Um, and I think in general, we just need to back up and remember that rates ebb and flow with the speed of the economy, and
Yeah.
that's been a fact. I didn't quite appreciate that like before I got into this business, but like in the year 2000, like one of the first like good days we had when was working in the middle of the tech crash when things were new was the day the Federal Reserve dropped interest rates for the first time in response to what was going on, and the market rallied. And I was like, "Hey, what's all this about?" It
Right.
was very interesting, but yeah, it's just part of the normal economic cycle, and we don't change strategies because of it.
Yeah, and it's funny for us nerds out there that follow this stuff. Like, it's a really cool time to like see what's happening, see the
Yeah.
changes. We can kind of nerd out on it a little bit, but
Well,
it is interesting. Some of the rhetoric that I'm seeing out there right now is, the fight against inflation is over, and now we're focused on boosting the economy, and that's not necessarily the case. And if you like
no.
dig into what Powell said, it's always
Yeah.
going to be about the data, right? Like, just
Right.
because we're at a place now where we feel comfortable doesn't mean in a month or two that's going to be the
Yeah.
same place, right?
Yeah. The Fed will be data dependent, which
Yeah,
they should always be
right,
data
right.
dependent. Yeah, and it's not like okay, inflation's over, now we're on to stimulating the economy. Instead, what they're really looking for is this elusive thing called the neutral rate,
Right.
right? What level should the Fed set interest rates at where it is neither stimulating the economy nor slowing it down?
Right. Yep.
But nobody really knows what that rate is.
Right.
It's
A
kind of
moving
like
target, right?
you're driving, right, and you're trying to keep your car at 45 miles an hour because you're in a that speed zone, and a little tap on the gas and you're going 48, 49. So you got to back off a little bit. And now you're going
Right.
40. So it's the same kind of thing. And there used to be a kind of consensus around 2.5% maybe being the neutral rate, but with
Mhm.
increased deficits, which we're going to talk politics here in a minute, but with increased deficit spending by the government and different things going on demographically, there's talk that maybe it's higher than that now.
Right. Yep.
So who knows? But that's what they're
So
working towards.
let's talk a little bit about like what this means for people, because as we said earlier, we've seen a lot of like, hey, this is what you should be doing, this is how you should
Yeah,
be thinking about like making changes to this, cash strategy. But I think it makes sense to kind of go back to the basics and talk about like how you should think about cash and how that strategy probably hasn't changed, right?
right, right. So, our point of view is always that you determine how much you should have in cash based on spending needs, and we start with the basics of cash flow, contingency fund or emergency fund, whichever phrase you prefer.
Yep.
And then anything you're going to spend in the next like 2 years, 3 years, depending on your point of view on being conservative or not. But money that is earmarked for near term spending goes in cash,
Yep.
regardless of what the rate is.
Yep. And it doesn't, I think people sweat too much about like, well, should I put that in a CD because it's getting 0.25% more? Like
Well,
that stuff doesn't matter, right?
no,
Like at the
no,
end of the day,
no,
it really isn't going to tip the scales one way or the other.
no, no. You're talking marginal differences, and it really comes down to, is that money going to be in cash for a year or two
Right.
years? Then a CD might make sense. You match
Right.
up the maturity of the CD to when you're going to use the money. And
Yep.
if no, you may need to spend that money next month, then it doesn't belong in a CD. It's pretty
Yeah.
simple.
Yep. Go
And
out and try to find the safest,
yeah,
best rate you can, but don't like scour the internet or,
yeah,
change banks every month because you're getting a little bit more somewhere else, right? You'll just drive
right.
yourself crazy.
And beyond that, some things to keep in mind, because we've seen this happen in other times when rates have been falling, is people that want income from their investments and want cash type investments do what we
Mm-hmm.
call reach for yield,
Mm-hmm.
right? And so we start from the premise that whatever something is yielding is an indicator of either liquidity or risk. You're
Yep.
either you're either locking your money up for some period of time, or you're taking some risk to principal.
Mm-hmm.
And so if one thing is paying you more than something else, you need to look at that and see, what the risk. And I'm not talking about like money markets between two banks that are FDIC insured. That just has to do with
Right.
how much money they need to have on their books at a given time. If they're paying a higher rate, they're trying to draw money in, right?
Yeah.
But I remember when interest rates were falling back in like 2000, 2001, people that would normally be buying CDs started buying like agency bonds.
Right.
And then after they were buying agency bonds, and those started to be those were maturing or being called back, then they started buying corporate bonds, because
Yep.
and not shifting their mentality to like say, hey, wait a minute, a Ford Motor credit bond that's 3 years long is not the same as a 12-month CD in terms of
Yeah.
risk. So
Yep.
just be aware. And it's not that all that's bad. You just need to, I think a lot of people aren't cognizant of that when they're doing it.
Yeah, well, we kind of talked about it last week when we were talking about investments and fraud, right? So we talked
Hmm.
about like interest rates are going down. We're seeing all these articles. We got heightened emotions, and that's when the salesmen kind of come out of the woodworks, and they
Yeah.
might find you a product that sounds really good to you, but it might
Yeah.
not be in your best interest, right? You might not
Right. Yeah.
understand it. Even if it has a way better yield that you can lock
Yeah.
in, it might not be the best thing for you. So you really have to be careful around like chasing
Yeah.
that yield and thinking about like, what am I actually getting into? We saw it in 2008 with mortgage bonds and things like that, obviously turned out very bad. That's an extreme example, but there's lots of
Hmm.
other ones as well, like you
Well,
talked about.
And like taking that to the next step is that lower rates are better for the stock market, because as rates come down on safer things, people do
Hmm.
take more risk and push
Sure.
more money into the stock market. And at the same time, hopefully corporations are then making more money because the economy is being stimulated. So the stock is worth more anyway. These things kind of all roll together in a way.
Yeah.
But just, be aware. Don't take your money just because all of a sudden you're not making 5% anymore on your savings account. Don't, push that money into the stock market without thinking about why you had it in cash in the first place.
Yeah, no, that's a great point because we do have this FOMO, right? Of like, hey, I've
Hmm.
got this cash, market's doing really well. Now all of a sudden that spread goes from, what was 5 to maybe 10 in the stock market to 2 to maybe 10 in the stock market. Now all of a sudden you're taking out your emergency fund. And I always think of things in terms of Murphy's Law, right? What can go wrong
Hmm.
will go wrong. The minute you need that money is the minute the market's down, and then
Right.
you're really in a pickle, right?
Right. Yeah. People lose track of what we call broadly correlations, right?
Mm-hmm, mm-hmm.
I think emergency funds are the easiest thing to think about. Like the day that you um, find out that you're going to be laid off is also going to be the day, probably, or a period of time when the stock market's really lousy too, right?
Right, right.
And so, if you think about like what are your risks are that you're needing to spend your emergency fund because you're being laid off at the same time the economy is slowed down and the stock market stinks.
Yeah,
I mean,
right.
so that's part of the logic behind when we talk about keep your emergency fund safe.
Yeah, yeah.
So good.
Safe and robust, right? Those are the
Right.
goals.
Right.
Let's switch a little bit here, Dave, and talk
Yeah.
about everybody's favorite topic right now, and the United States and politics and the election
Yes.
coming up, right?
Yes. All right. The people that we've talked to recently seem to be very well aware that there is a presidential election coming up,
Right.
and not without, we're certainly not dismissing those concerns around volatility in the elections. But as we've said earlier, issues of this podcast on our blog, and I've seen some very smart people writing about it in the industry as well. The market really doesn't care who the president is
Right.
in general.
Yeah.
Um, we've gotten questions lately about specific policies and like which candidate would be better for the economy and for the markets. We've got one candidate that wants to lower taxes in general on corporations and at least increase deductions for a lot of people, and also put tariffs on foreign trade, which all those things have their pluses and minuses. I don't want to
Mm-hmm.
get too specific on like how we feel about certain things, but essentially tariffs increase prices and are inflationary. And
Yep.
we can debate the merits of tax cuts in a situation where we already have scary large deficits.
Yeah.
We've got another candidate who wants to increase taxes on certain parts of the population and on businesses to the point where there's questions about like what impact would that have on economic growth and investment and keeping the economy growing the way it always has, which is good for everybody. you know um, and talk of taxing unrealized capital gains, which seems very hard to implement. um, so you've got two very different policy stances, but I don't feel good about either of them in terms of what they would mean for the economy for different reasons.
Yeah. Yeah.
You know,
We have this dynamic of like, we kind of know where both sides of the aisle, and we know the states that are going to vote there. And so now it's about
hmm
like, how do we get to the people in the middle, right? And how do
right?
we like, how do we make things sound like we're trying to help them so they'll vote for us? Meanwhile, the market's over here going, hey, you know what we want? We want one of these, candidates, and then we want the different, political party to be in charge of
Yeah.
Congress, because that way nothing happens,
Yeah.
because what the market doesn't like is uncertainty, and they don't like change. And so if
Yes.
none of this stuff that they're talking about can happen, the market would really appreciate that, right? And so that's like
Yeah.
the separation of what the market wants and what your investment wants, and then what's going on politically and what you're hearing out there.
Right. Right. And it's unlikely when push comes to shove, we have to remember, our Constitution created a weak executive office on purpose. The president
Mm-hmm.
really does not have the power that we attribute to them or that they
Right.
claim to have when they are campaigning in August and September before an election. Neither
Yeah.
of them can change the tax code.
Right.
Neither of them can, you know, seriously change the regulatory environment without congressional action.
Yeah.
And even if one party controlled both houses of Congress and the White House, that's still a pretty broad spectrum of constituencies to expect them to increase taxes significantly or make large changes that are going to be inflationary or any of the types of policies that either candidate claims that they want to enact.
Right. Yeah.
So, long way of saying we don't see a lot of risk in either of these policy packages being delivered.
Right. What's interesting? Well, a couple of points on that. One is Freakonomics did a great podcast episode on like the weakening power of the president. So if you're worried that the candidate that
Yeah.
you want isn't going to win, and the one you don't want is, like, listen to that and like get some reference on like what that might
Well,
actually mean, because it's probably a lot less than what
yeah.
you would. So, Dave, let's talk a little bit about, the economic side of this and what that might mean. I mean, it looks like both candidates are gearing towards, what will potentially raise the deficit. And I know there's been a lot of talk about that and what that
Right.
looks like and how far up we can really go with the deficit. Let's talk a little
Yes.
bit about that.
Yeah. There's the expectation that if one candidate lowers taxes and raises tariffs, it won't offset spending, and same with Harris's tax proposals. It wouldn't raise enough to cover her expanded spending that she has in other parts of her bill, or her not bill, you know what I mean, her proposals. So,
Right.
so yeah, either one is likely to increase the deficit from already high levels. So, from that standpoint, the question is like how long and how big can deficits become before it's an issue for the economy? And that's been an economic philosophical debate going back at least to to Keynes, Maynard Keynes,
Right.
if not before. He formalized it at least. But the idea being that government spending stimulates the economy, but government debt is a drag on the economy.
Right.
And so it's like this yin and yang of like, okay, if government spending is good, provides jobs, growth. Government debt takes money out of the economy, and what is that balance? Um, I don't know what it is, but I do feel like uh, so one school of thought on on this topic is that governments can just inflate their way out of debt. In other
Right.
words, if government debt becomes too big or is seen as unsustainable, they just allow inflation to rise so that those payments, because you're paying, think about it in terms of your mortgage. If you're paying $500 a month or $1,000 a month on your mortgage over the course of 30 years, if there's 3% inflation, that $1,000 a month is worth less 30 years from now and is not as big a deal. And if inflation is 5%, it is a bigger impact, right? That payment
Mm-hmm.
is next to nothing by the time you're done. Um, the flip side of that is, what do voters hate? Inflation.
Yeah.
so so you know I I had an interesting talk with a client who's pretty astute about this stuff, and we were talking about that, and he's like, well, there's always the inflation side of it, and we can inflate our way out of debt, but I think we're also seeing the cost that inflation has on the American voter, whether it's real or psychological. We don't tend to vote for the party that was in power when there's inflation.
Right.
And so I've always thought, while in an economic vacuum, that idea of inflating your way out of debt works, I'm not sure how that would play out in reality.
Yeah.
So
Yep.
bottom line, at some point we need to get serious about fiscal balance. But
Yeah, I mean, hopefully, because there has been always been this ongoing debate of like how high can it go, right?
right,
Before things break. Like, hopefully, we never find out,
right,
right?
right,
Like,
right,
that's the goal.
right. So
Um,
the
so let's talk.
go ahead.
Let's talk a little bit about like the bottom line. What should we be thinking about? How is this going to impact things, and how do you kind of prepare for what's next?
Well, the way I would look at it is all of these issues are important. They're all important, and you should definitely vote, and you should vote based on your values and think through the issues as best you can, recognizing that they're all intertwined, and this isn't an easy thing. But consider them seriously and in context. But just always bear in mind that when it comes to your portfolio, politics' role is much less important than basics of economics. That
Right.
it's the stock market's going to rise and fall with the economy and rise over
Mm-hmm.
time because the economy grows, and um, the president in particular can only impact it so much.
Right. Yeah, I think we get, really wrapped up around like what's going to happen with the markets and investing, but there's a lot of important things going on right now politically outside of the economy,
Right,
and yeah, they're going to talk about it a lot, but at the end of the day, like you said, they're not going to have a major impact on it. So I wouldn't worry about it or focus on the investment side
right,
of it when you're talking
right.
about who you're going to vote for and why.
Yeah. So, yeah, like another way maybe to state that would be when you're thinking about the values that you have that you want to elect officials on, maybe expecting them to fix and change the economy shouldn't be like the main priority, right?
Yeah. Right.
So, because they're not going to be able to do that much. The economy is going to be what it's going to be.
Right. Yep. And this too shall pass, right?
We shall survive. We shall
Well, Dave,
survive.
this has been a pleasure. I don't know if we helped or hurt, but hopefully,
Well,
hopefully you got
I
some
think
good information out of
if
it.
nothing else, we helped ourselves by talking through it,
Yeah,
right?
exactly.
So good.
If our listeners have any questions or comments, feel free to shoot us an email at info@srbadvisors.com. Dave, as always, it's been a pleasure.
Thank you, sir.
This is a Zedia Media production.